And we stick to the topic of nature and plants because the next panel is on the nature finance funding gap. And maybe for me, the most special and promising session of the whole event, because this is about building the investment case for the private sector when we talk about nature. And this discussion is going to explore why nature is a crucial pillar in addressing climate change. Alongside renewable energy and sustainable food systems, nature is really essential there. This topic is, I think, really top of mind, and I'm keen to hear from the impressive group of speakers. And I would like to welcome the speakers in a bit on stage. On behalf of WWF, we have Vermeulen. The Finance for Biodiversity Foundation, we have Anita de Horde, Gemma Roex from Phenix Capital, the Impact and Measurement Management Lead. Welcome on stage, and the floor is yours.
Here we go. Thank you, Carlijn. Thank you, everyone, for being here. My microphone is slightly falling off, so apologies if the audio might be somewhat soft, but let's go. Over the next 50 minutes, we will be discussing the panel discussion, building the investment case for the private sector, addressing the nature financing gap. So thank you, Phenix Capital, for having us. Thank you to my wonderful panelists for being here. I will give you a little bit of a scene setter about investing in or investing for nature, and a few other details before we'll dive into the questions that we prepared for you. Keep your cards, your color cards, close by, because there will be some questions in between where we're going to ask you to do something. But first and foremost, today we explore one of the most complex and urgent challenges of our time, integrating nature into an investment equation, not just as a moral imperative, but also as an essential pillar of sustainable development and financial strategy. Just to frame the conversation, I will just share two concepts with you and one definition, just to make sure that we get off on the right foot. First and foremost, if you're if you don't know it, it's the SDG wedding cake of the Stockholm Institute, where they've divided all the SDGs in different tiers. And the lowest tier, being the base of everything, is a biosphere tier. Without having a thriving, resilient natural environment, the rest of our ambitions crumble. And the SDGs which are located in the biosphere are life on land, climate action, life below water, clean water, and sanitation. So those are the 4 SDGs that the Stockholm Institute says really make up the biosphere and will help focus any investment activities that you do if you tackle those SDGs. So the other one is that wave imagery that we all know, these waves coming crashing over, where the first wave represents the immediate crisis of climate change, which is already here, and then the second wave coming that follows, where the biodiversity loss wave looms quite large over climate change. So that is where we are, and that is what we have to tackle as investors. And before I head into a last little bit of information about the size of the nature financing gap, I thought I'd leave you with the definition of investing in or investing for nature, because that'd be a helpful part of this conversation. So investing for nature, and then I will look at my notebook to make sure that I say it in the correct way, is investing in those activities that are reducing harm or have a positive by-effect for nature, but not a direct improvement in biodiversity. So that is investing for. Investing in nature is harder and a bit more complex. Finding investable, profitable, or not yet profitable businesses, models that are directly adding to ecosystems as a result of their business activity. So those are just 2 things to keep in mind. We will be using investing for and investing in maybe interchangeable, but those are the differences between the 2. And then numbers. So how big is this nature financing gap that we're talking about? So a Cornell study showed that we will need $700 billion by 2030 annually to do all the biodiversity restoration and conservation needed in marine and land areas, for sustainable use of land and reducing water pollution. Currently, the investments collectively, globally, stands at 150 billion annually. So that is the gap that we're talking about, and we don't have a lot of years to do it. So joining me here are Gemma Roex of Phenix Capital, Anita de Horde of the Finance of Biodiversity Foundation, Aaron Vermeulen of the Worldwide Fund for Nature. Apologies for not saying it in the correct way. They will give you a more detailed introduction about themselves in a second. Also, because we know it's after lunch, we're heading into the last bit of this wonderful conference. Please feel free to ask questions. So there will be a section later on where we encourage you to stand up, ask your questions, grab a microphone, and don't miss your chance to ask these experts. But first, grab your color cards and tell us, are you already investing in or for nature? Then the blue is a no, the yellow is a yes, or orange is a yes, and then pink, considering it. Let us know. So I can see a lot of orange and pink. So blue, a no, less of that. That is perfect to hear. Question number 1, which we covered, where I'm going to ask Gemma, Anita, Aaron. Please tell the room more about yourselves and what you are passionate about in your work.
Sure, I'm happy to kick it off. So my name is Gemma Roex. I'm the Impact Measurement and Management Lead at Phenix Capital Group. At the moment, there are kind of 2 main hats that I wear when looking at kind of the nature financing gap and investing into natural capital. We help both LPs to build their impact mandates, so really helping them to build out their investment criteria, doing the long listing, short listing, and then impact due diligence. And so what's very interesting there is we're really seeing an increased ask from LPs. How should they build, well, predominantly biodiversity as a theme into their investment portfolios? So how can they invest into it with a positive, measurable intention? So kind of building out those investment criteria is something that I get a lot of energy from. And then on the other side as well, helping GPs to build out their impact measurement and management frameworks in their funds. So again, if you're looking specifically at a biodiversity or natural capital strategy, how can they build a good theory of change, but also how they can assess their investees that they're looking at for the impact potential, and of course their measuring and reporting practices. So both of those give me a lot of energy, and yeah, they're very interchangeable, as you can imagine, because you help the GPs to prepare for the institutional level due diligence from the LPs. Yeah.
Great. Well, hello. Really great to be here with you. My name is Anita de Horde. I'm the co-founding executive director of Finance for Biodiversity Foundation. It's a foundation, non-profit organization that is built from and with investors, asset managers, asset owners, but also banks, and we also have impact funds in our community. We are a community of around almost, we need 2 more, so maybe it's one of you, signatories of the Finance for Biodiversity Pledge, and that was a commitment launched in 2020. It was prior to TNFD, it was prior to the GBF, Global Biodiversity Framework adoption, so it was not hip and happening yet back then. And we grew out almost 200 of institutions. So I can say, and what makes me enthusiastic is that it's a growing topic. When I started working on the topic in 2017, it was a small group of institutions that really looked into the measurement side, but also how to invest in nature. And now it's becoming mainstream. So that makes me wake up every morning to contribute to that goal. Maybe shortly on what the foundation does. So we support financial institutions, the broad range of types of institutions in starting to understand nature in their portfolio. So that means engaging with companies, setting up biodiversity policies, but also assessing the impact and dependencies of portfolios. And the hardest one, and we did a long time to think on how can we all set targets on nature. Now we've done that now for 4 or 5 years. We're now going to open up and that's a little news for you here, also to other types of institutions that want to learn in a fast track on what we've done in the last couple of years, and also looking into more in depth into what does nature mean for specific asset classes like sovereign debt, real assets, etc. So that's something we're building up in a big program called Nature Positive for Finance. I will stop here.
Aaron.
All right. Good afternoon, everyone. My name is Vermeulen. I'm the global lead on sustainable finance within WWF. So there's an acronym which is much easier.
Yes.
And I oversee a strategy that is executed by about 200 of my colleagues who sit in about 30 offices worldwide on sustainable finance. And why I'm excited about this topic is, well, we have an index, not a stock index, but it's called the Living Planet Index, which is going down rapidly. So we've seen a decline of about 70% in the past 40 years in the abundance and diversity of nature. And I see a big potential in engaging with the financial industry to bend that curve of biodiversity decline. So that's what I'm excited about. What we do is two strategies, sub-strategies. One is greening finance, so how can we integrate nature considerations in the way financial institutions make their decisions. So Anita and team are doing a great job on that. WWF was one of the co-founders of the Task Force on Nature-Related Financial Disclosures, TNFD, which by now has about 500 adopters globally from the corporate and financial sector. So that's one of the things we're doing on greening finance. But we're also working on financing green. So how are we going to mobilize more capital to the places where biodiversity abundance exists? We're doing that because we know that philanthropy is by far not enough to fill that gap that you talked about, Suzanne. We started about 40 years ago on that topic. It was a staggering 1 million deal in Ecuador. It was the first debt for nature swap ever to alleviate the debt burden for the government of Ecuador. But that transitioned into a broader portfolio of blended finance work, which we're doing with FMO, Dutch Development Bank, with the EIB, with the Asian Development Bank, and these are portfolios of a couple of billions for each facility in which we are basically activating the ideation, origination part of these blended finance facilities.
Thank you. Thank you. So in our calls, when we prepared this session, we had a very interesting discussion about how investing in and for nature kind of lives on a spectrum from investments done for mitigating risk, positive impacts investments, and then nature positive investments. And then the nature positive investments and nature positive solutions that those investments go into are pure play solutions that tackle biodiversity loss directly. So what I wanted to ask Anita is just give us a bit more, could you tell us a little bit more about that spectrum that you beautifully mentioned? And then Gemma and Aaron, if you have some examples that we can give of those nature positive solutions or and investments that the room would like to know.
Great, yes, sure. So we've launched last summer, before COP16, we launched a discussion paper, and we had around 200 organizations and experts looking into when can we call something positive impact investments in nature, and when can we call it a nature positive investment. And what we've done, we used all kinds of frameworks that are out there. We worked together with the World Bank and others, IFC, to really tap down the differences. And basically the differences is positive impact can be any investments, investments in positive impact that contribute to restoration or conservation from nature. And the difference is with nature positive is that you also need to make sure that you first mitigate all the negative, harmful drivers of loss for nature. So that means you need to make sure that you measure the investment and also to make sure that it's first reducing and halting the negative effects on biodiversity before you can claim it's nature positive. So that's basically what we now have as a sort of working model. You can find it on our website as well with more information and more references to all the frameworks out there. And the next steps, and we're very excited about that, is, okay, how do you bring this then in practice? Because this is all theory, and that's nice. And can we have a sort of examples and a taxonomy on what it means for different types of asset classes, what it means, when can you claim it's positive impact, and when can you claim it's not nature positive. And that's particularly interesting because you see a rise of also biodiversity funds, of listed equity coming up, great developments. But how do we make sure that's what's in it? And we have a lot of discussions in our community, in our working groups with our group of institutions. Some listed companies that are in some biodiversity funds, other might find that a positive impact investing, but others say, well, we have these companies on the exclusion list. So really great debate, and also to standardize together and really look at what is the theory and how can we bring these discussions and this sort of taxonomy then in practice. And we're building this for the coming 2 years. So we're getting our heads in what does it mean, and hopefully in 2027, but already earlier, there will be a sort of framework out there that everyone can use.
And you mentioned listed stock as one of them. Listed equity, you say, is that more part of a mitigating risk strategy than a nature positive investment?
Yes, indeed. So it's very hard, of course, for a listed equity fund to become nature positive, because there are not so much listed companies that mitigate all of their negative, harmful activities on nature and only claim positive. So how you see it, and what we would like to see, is how can you build then these transition. And what ideally this would mean is, okay, look at the main sectors and investments you can have in sectors that are meaningful for nature, and then see what is a really no regret, what is the transition in time, and what are then the innovations of that sector. And that's something you can also do, according to us, with listed equity.
Okay. Gemma, Aaron, I'm going to ask you can you give us some examples, apart from, of course, the project, the blended finance project that you already mentioned, of these pure play nature positive solutions that you feel are very much contributing to biodiversity loss, and that you've been developing at WWF?
I can. And before I do that, maybe a little bit of addition to what Anita said. Because I think in a way WWF was one of the culprits why this investing in natural capital became so confusing, right? Because on one hand, yes, you can invest in rivers, mangroves, forests, but generally these don't provide solid returns, and the market is really small, right? There might be some returns coming out of carbon, biodiversity credits. So, and what I really like was the framework that the multilateral development banks launched 2 years ago in Dubai, which are the common principles for tracking nature-positive investments, finance, I think, which makes a distinction beyond the mitigation part, right? So how can we reduce the pressure on biodiversity?
Yeah.
And then the second part is how can you then invest in nature, right? And I think the biggest market is in the first bucket. So how can you invest in activities, companies that help reduce the pressure on nature, because in that way nature will make that bending of the curve move. So an example, well, we are working in the Cerrado woodland in Brazil for decades already, and there also the curve is going down. Why? Because there's a massive soy production happening in that landscape. It's a big part of Brazil is covered by the landscape. And we've been thinking about ways how to stop the deforestation of that woodland and provide incentives to the soy producers to produce soy in a different way. So we're working with a large agricultural bank to think about how can you provide financial incentives, reductions or discounts on the interest rate if they keep a part of the forest that they are legally entitled to cut down, if they keep that standing. So make that a part of the collateral of that specific company. And then together with some de-risking from development banks in Brazil, you can then develop credit lines to these soy producers to, on one hand, stop cutting down the forest, reducing agricultural inputs, and so reducing also pollution of surface waters in that specific landscape. So that's a very practical example how with blended finance, with commercial banks, development banks, you can develop credit to these producers to make that transition that Anita was talking about.
Gemma?
Yeah, absolutely. No, I think you have both covered a lot already, and I think maybe just to add, I think we've already seen the example. I think real assets, forestry and agricultural for farmland funds, I think are often the most tangible way of kind of investing into natural capital. And maybe to add to what you were saying, like I think you described the outcomes very well and the ways that you can invest. I think the timeline is something to really bear in mind as well. So I think for LPs investing into natural capital, obviously it takes a long time for the natural capital to mature and for the outcomes to really be realized. So I think what's very important as well when we look at kind of GPs is looking at what's the duration of the positive impacts that you're going to have. So what's the chance that the positive practices that are being implemented might be reversed? If you're looking at a forestry fund, for example, it's very important in a GP is making sure they have responsible exit practices in place. So if there is a new buyer of the area of the forest or the farmland, what is the insurance that the new buyer will continue the positive practices and isn't going to reverse the agricultural practices, won't cut down the timber that's been created? Because then, again, you might have created positive impacts during your holding period, but then they're going to be negated afterwards. Yeah.
Thanks. The other thing we wanted to tackle are, of course, the barriers too. So we talked about the differences between investing in and for nature, and Anita shared how the spectrum goes from mitigating risk to positive impact to investing in nature-positive solutions. Now, the mitigating risk part, Anita covered beautifully already, and of course we've already seen some examples of nature-based solutions. But investing in positive impact is kind of that transition investment to go from mitigating risk to investing in nature-based solutions. So I'm curious, dear panelists, what are currently the barriers to increase, let's say, the financing into that positive impact section of investing in nature? Of investing for nature, apologies.
I can start. I think when you let's make a distinction between private equity and public equities. On the private equity side, I think there's a lack of stuff to invest in. So how do you create a meaningful, sizable pipeline of investable companies that have a nature-positive solution? So as I said in my introduction, WWF is involved in a couple of blended finance facilities with development banks, where WWF plays that origination role. So we don't only look at the financial side of that particular deal, so we're supporting the company to also look at offtake agreements, how they can have longer-term relationship with buyers in order to have access to capital. But we're also looking at the context in which that company is situated. So it's not only about the impact they're delivering within the fence line, but also are they then there in a bigger landscape where nature exists, and is that particular farmland going to improve the water situation in that landscape? And of course, the company doesn't have money or resources to quantify that impact, and that's why they work with WWF offices on the ground to then also quantify that context and quantify the impact they have in that conservation landscape. So origination and also financial resources to do the origination is key. WWF has been involved in the Dutch Fund for Climate and Development, which is now a 1.3 billion facility, and about 70 million out of that was invested, or not invested, actually put in the shape of grants to companies to develop that pipeline. So just to give you an idea of, it takes blood, sweat and tears to do that. Mm-hmm. And then on the public equity side, data is still an issue. So so a couple of ideas that WWF explore with asset managers is the Biodiversity Equity Fund that we launched together with Robeco, where we used annual reports of companies to start ranking companies whether they are actually providing solutions towards nature or whether they were transitioning towards nature positive. And as we speak today, we launched a partnership with MSCI, where we are combining our risk filter suite with the asset level data suite of MSCI to also help list companies quantifying how they are impacting or depending on nature.
Those are some very practical examples, yes. And Anita, would you have anything to add?
Yeah, it's a really large question, right? Barriers in, and then in what type of investments are we talking about? Now, yeah, data, that's also what we see. There's a lot of data, but the problem for mainstream companies is that they don't disclose it yet. Yeah. There are all ways to then identify. Still, there's enough data out there or tools out there, and we have a measurement guide also on our website available in which you see different types of tools measuring what exactly. So this measurement approaches guide was, we launched it in 2019, I think, 2020, and it's, yeah, a lot of people are using it to really understand how to do that on different levels. So data, measurability, how can you still engage with companies if it's listed and corporate bonds, if there's no data available, start asking for it, I must say. So that's one side. If you really look at the real assets, it also depends. Are you an asset owner? Then probably you're new at the topic. I regularly receive questions. Yeah, we have 50 million to spend. Where do we need to put it? Yeah. Now, that's also a large question. Like, what impact do you would like to make? How does that sit within your complete portfolio? What is your strategy? And then you can look, what kind of sectors or would you like to make an impact? And then you can tailor down on what is then available. And is that then, does it need to have a return? Yeah, then you need to look at sustainable use, so more the innovations of the sectors. Yeah, or is it just real assets and natural capital investments? And then you need to look, is it conservation or is it restoration? The barriers in these is that asset managers then say, yeah, there's a shortage of, the pipeline is small. That's what we hear a lot. There's not a lot of projects out there. But the people that have the projects they say, we don't find finance. So we see a sort of matchmaking a problem there. Usually they're very small scale, so there needs to become, and that will come more often, instruments on how you can pile up small investments, so it can be also interesting for asset managers or asset owners to invest in. So you have that side, and then also looking at what you now more see, and we are deep diving in that as well. How can you really look at the innovations also of real assets? What does it mean? Natural capital, land, reforestation projects. How can that have a return? And what language do we all use? And are we sure this is a right project, right? Mm-hmm. And then it's very handy to overcome these barriers, to work with local partners or to work with institutes or WWF or others to work together towards making sure that you're making the right impact.
Mm. Yeah, no, I think I really agree with what you say. I think we see as well, we've been involved with some LP mandates on kind of biodiversity themes or food and agriculture. And I think, and also real assets or farmland search. I think if we look, so Phenix tries to track the impact investing universe. When we look at our database, just 6% of our funds are focused on farmland or forestry. So that's quite a small amount. So I really recognize what you're saying about the supply and demand. And then if you dig into that even further, if you look into those farmland and forestry funds, about 58%, I believe, are focused on developed markets, 20% global, and the 22% are in emerging markets. Whereas you just said that earlier, Aaron, like the real stock of natural capital is found in emerging markets. And so if you look at that, it's not just how can we mobilize more capital towards or investment towards natural capital, it's going where it really is needed. And then I think when we then look at or talk to the LPs, you've got a couple of issues. You know, currency risk is just a big issue. And then how can you de-risk that for investors? And then also, exactly like you're saying, Anita, having slightly newer or smaller GPs, then also based in emerging markets, they're not just always ready for institutional level due diligence, and they're not of the institutional quality that the investors are looking for to invest into. And so, Aaron, I think coming back to what you were saying, having instruments like blended finance, but I think there's also a lot of more of these kind of innovative financing instruments that I'm sure you both see a lot that can help de-risk these for the investors and then help to mobilize more capital.
Great. I would like to comment also on your beginning statement, the 700 billion gap, and there's a lot of money in that needs to be repurposed, right? There's a lot of subsidies, reform needed and then if you really look on what money is needed on the ground, that's less than that amount. So that's also something why what Aaron says, really true. You first need to work, the big pile, the 99% of the private financial flows needs to be reduced, the harmful effects on the drivers, on the pressures of nature. So that's really essential. And then, of course, the money and the investments in natural capital, in restoration, conservation, but also the innovations of the sectors, of the food and agri sector. And the food and agri sector is the renewable energy sector of climate change, right? So all innovations and all these innovations that are needed there to really do different businesses is needed and also can have a return because it's so there's a huge opportunity to go in that direction and not only look at natural capital investments and not only look at reforestry projects.
Can I?
Well, Anita completely tackled the next question, so please continue the conversation, Aaron, because we were going to discuss which other sectors come into play and what are the opportunities in the sector. So please continue, Aaron.
No, I wanted to respond to what Anita said, because in the session before this one, which was about foundational impact investment, there was a remark made like, okay, we can only make this happen if you develop a kind of an ecosystem of different actors around these investments. So while impact investment maybe 10 years ago on renewable energy, where it was quite linear, right? You had an investee, an investor, you had a regulator, and that made the deal. And now, the examples you gave, you need to create an enabling environment, I think, and see how you can redirect these subsidies to provide incentives to these companies that want to make the transition. You need buyers who get into long-term agreements with these suppliers. You need de-riskers, you need maybe organizations like Finance for Biodiversity or WWF who have the stamina to put them all together, right? So I don't think biodiversity or nature investment is complex. The topic is not complex, but the transactional cost might be a bit higher than with greenfield type of investments.
So there is a role to getting everything organized, to organize the different stakeholders to sit together. And that is part of bridging the financing gap, to making sure that the right stakeholders are sitting together. You mentioned the agri-food sector. There are other sectors that have significant effect on biodiversity loss. But I believe at the Foundation of Biodiversity, you've done work in identifying key companies that are either tackling biodiversity loss or are particularly adept at mitigating risk. So diving into which other sectors come into play with regards to investing in nature, is there anything you would like to share? I know agri-food is the number one to go for.
Yeah, no, absolutely. We've, as you said, also been involved in a kind of agri-food search, private equity for the asset class. And I think there are two kind of typical strategies that we see. So we see either the more transitional strategies, so that are looking at, take an avocado maker, a tomato grower, something like that, and really changing the operations of the company. So reducing the water inputs, kind of helping to regenerate the soil in some areas. So that's kind of one typical strategy that we see. And then we also see the more, what we call the solutions-orientated strategy. So it might be creating drones for precision farming. So helping to, again, like reduce the pesticides or chemicals being put into the farmland. But it could also be, alternative proteins as well. That also can have a big knock-on effect in terms of biodiversity investments. And then I think if you kind of take one step back, I think both of those strategies are needed. If we're going to really halt and reverse biodiversity loss, I think both of those strategies are needed. So then it really comes down to, I think in our case, the intentionality of the investor, of the LP. You know, how do you want to put your capital to work? What's your theory of change? How do you know, through your activities and investments, what are the changes you want to see? And measuring that through, well, in this case, relevant metrics that you'll measure across the portfolio. So really identifying their investor contribution and then seeing which of those strategies fits best for the LP mandate. Yeah.
Yeah. No, I would like to contribute that, yeah, the measurement approaches are out there. So to really measure private equity or corporate loans towards, that's easy. The big problem to tackle sectors is to see a big pile, a portfolio with a lot of companies in it, and especially when it's listed equity or corporate bonds, then you have a sort of problem. How do you tackle that? So we did indeed a study to look at the MSCI ACWI Index, 2,300 companies we identified. They don't disclose yet on all the drivers of loss, so not on water pressure, not on pollution, not on water withdrawal, all the topics. And that's why, you need to find a way to look at this data. There are a lot of footprinting tools at the market. They're not perfect, they're model data, but it can get you started. And what we've done a study with the four main footprinting tools. And we asked them all to come up with a benchmark of the 2,300 companies. And what you saw in that exercise, and they measured their impacts on nature and their dependencies. And what you saw there was the list, who's everyone would like to know who's the worst of the worst. But yeah, the food and agri sector, the companies in that list, these have the biggest impact. That came from our study, but also what was a sort of positive news, especially for the asset managers there, is that from this whole list, 2,300, there was a group of 200 companies exposed to around 73% of the impact of the entire MSCI ACWI. And that's sort of good news, because it means that focusing on a small group of big polluters, let's put it like that, and putting emphasis in changing would make a huge difference for nature. So you see it's more dense. With climate change, it's more spread over all sectors. And with nature, it's a small group of sectors and a small group of companies that are responsible for the biggest impact.
So also an opportunity in engagement and in other activities to move these companies to do different things.
Exactly.
Yeah.
Yeah.
Aaron, anything you'd like to add?
Yeah, maybe add on top of the food and agri, I think energy and infrastructure are sectors that have a big impact and are depending on nature. So there's always this misconception that by just investing in hydropower, you do a good deal for climate, of course, because you're taking out the fossil fuels. But then if you're blocking rivers and stopping nature to flow, fishes to flow, and also impacting protein supply to local communities, that could have a massive impact. So thinking about spatial planning of infrastructure, of hydropower, and where it has the least impact, these are definitely some emerging topics in these sectors. WWF is also working with linear infrastructure planners and how knowledge of where biodiversity sits and how connectivity between different nature hotspots works, how that can then influence the design and location of railways, roads, and other linear infrastructure ways. Yeah.
Making infrastructure a nature-positive investment. There is time for a few questions from the audience. I have time for two. Is there any burning question from anyone in the room that I see one there, and the microphone is coming your way. Would you mind just standing up, saying your name and which organization you're from?
Happy to. Hi, I'm Cecilia. I work for Kofor Holding, and this is a fascinating panel, so thank you. I guess my question is on the impact management and measurement side. how do you measure the positive outcomes on biodiversity, actually? Yeah, have you come across any very good KPIs that I keep searching for and can't find? Thanks.
See, this is perfect, Cecilia. That was our backup question, if there were no questions from the room. So who would like to pick this one up?
Sure, I think I can start by saying I think there's there's two, when you're looking at biodiversity, right, you've got the risk side, which I think we've covered quite a bit as well, like that's almost kind of a bit more backward looking, like what is the footprint that you have, what is the negative impact you've already had, and then I think you're referring a bit more to like the positive intended outcomes. And I think that that's a real challenge. I mean, that is also another barrier. I don't want to cheat by saying more barriers, but another real barrier, I think, to investment. And I think it is really tough to find metrics that are aggregated. And I think that's got to do as well a lot with the fact that when you're looking at biodiversity, it's very like spatially dependent. I think, just like you were saying earlier, Aaron, it really depends on the ecosystem, the species that you're trying to measure. And then you've also got the idea of, are you looking more at averages, so mean species abundance per square meter, or are you looking at the real like specifics, like the number of species that are on the REDD, like kind of the red list. So yeah, I think, I don't have an immediate answer for it. I think it does come back to what is your theory of change, right? What is the outcome, the intended positive outcomes you're trying to achieve, and then trying to backwards map that. So going from the impacts, the outcomes to your immediate outputs, and then trying to find the most relevant metrics for that theory of change that you're intending to achieve. But.
No. Fantastic, yeah. No, really echo that, what you said. And it's positive impact investing in nature. There are not a lot of frameworks out there. So we're also now, this is exactly the same question we're asking ourselves the coming 2 years. So we're building that sort of taxonomy. And echo what you said, Gemma, on, it depends on also the sector and the effect that sector or that country, because we also have country investments, wants to make. So it depends on where you're looking at, how you can then contribute to the best. But it's indeed the state of nature. Can you prove that it's changed in positively the ecosystems, and then and mitigate then the drivers of loss, the pressures, the key pressures? That's basically central. But how exactly it will look like? There's no taxonomy. There's an EU taxonomy, of course, but there's no taxonomy at this moment that really pinpoints now, okay, and we do aggregate to pollution, water withdrawal, and that type of, but that's not really positive impact. So you really need to turn to, do you make a difference? And then location specific is also very important. For instance, if we look to the Netherlands, we have huge exposure on, with our agri-food sector, we're the biggest meat exporter, and we have a huge nitrogen problem in the Netherlands. It's the same topic, it's agri-food, but if we turn to Australia, it's not nitrogen, it's not dense close by farming, no, it's the opposite, it's land use change. So it's exactly the same sector, but a completely different reality because it's in a different country. So that's how, and that makes it complex. So nature is not complex, what Aaron says, but the local reality makes it complex. So if you contribute to nature, and the state of nature depends where you're measuring.
Thank you. So out of respect of everyone's time, I will cut it off here and just leave it at one question. Any burning questions you have, please speak to one of the panelists in the upcoming break. There are so many different investable nature-positive solutions that the speakers here have mentioned. So please have a look at their websites to see about what different frameworks are out there, what different blended finance solutions are out there, and particularly think about the theory of change, of what you're trying to achieve. Are you going to invest in, or are you going to invest for nature? Are you looking at mitigating risk, or are you looking at this nature-positive, trying to generate this nature-positive effect? So, lost for words on that one. But I will ask one final question to our panelists, and just to make sure that we all leave with the takeaways that we'll feel in in the core of our soul. For you three, what would be your, if you can take away one key point of the discussion that we had today, what would that be?
Well, can I say two? Sorry.
So
the key takeaway is well, the TNFD framework is an excellent framework for you to test your portfolio and start understanding the risk and opportunities. And on the data side, for now, until Anita and team have developed that impact framework on the ground, keep on focusing on how you can work with your investees to reduce the pressure on nature in their supply chains.
Yeah. Thanks, Aaron.
Yeah, I would say just try to attempt measuring your portfolios first, seeing where you have your impact, and then see what are the opportunity side and what fits best with your strategy. What kind of sectors and what kind of improvement, nature improvements, innovations in different types of sectors is needed. It's great way to invest in sustainable use of these sectors. And then also real assets. Now, yeah, help is on the way, but natural capital assets, yeah, if you have a strategy in place, start looking into it. There are different examples out there. And start deepening your knowledge and see if you, if it fits with your strategy.
Yeah, I think for me, I think when I was preparing this, I saw a data point from the FMO that said that just 20% of investment in natural capital right now comes from private markets. The rest is all public funding. So just the question of not only how can we mobilize more private capital, but really making sure it's going to the right places, the right regions, and the right projects. Yeah.
I would have a very simple takeaway. Do it. With that concludes this panel here today. Again, tackle any speakers if you have some burning questions for them. But for now, thank you so much for your time and for all your expertise, dear speakers, Gemma, Anita, and Aaron.
Thank you.